This is Sharon Garvin of Wayne State College, and this is my screencast for Chapter 3A for the Accounting 1 online course. Chapter 3 in your textbook deals with bookkeeping. That is, how do we get the information that we're going to use to prepare the financial statements we learned about in Chapter 2. There's two major topics that we have to cover in Chapter 3. The first is transaction analysis, to think about business events that happen and how they affect the accounting equation, and eventually how they'll affect the reporting of the business events on the financial statements. The other relates to accounting language issues, knowing what the terms debit and credit mean, and how those are used to help us record the information into the accounting information system that we will later use to prepare the financial statements. Notice at the top of this example problem we have the accounting equation, that is assets equals liabilities plus equity. In layman terms, that again means that the property or resources owned by the company are claimed either by creditors, suppliers, vendors, bankers, people we owe money to, those are liabilities, or we owe the rest of the asset resources to the stockholders, the owners of the business. That's known as equity. Example types of things that a company might have for assets would be cash, which consists of the balance in their checking account, money in the cash registers, those types of things. Accounts receivable is an asset. We have a legal claim against some of our customers who have purchased merchandise from us or who we have provided services for who have not yet paid us. So we have a legal right to sue them for these amounts. It is an asset. It's an amount that they owe us and we'll be receiving from them. That's why it's called accounts receivable. Another example would be inventory, which would be the cost of the merchandise we have for items we put on the shelves if we're a retailing business that sells items to the public. Another example would be equipment, the types of machines that you have either in your store or in the office that you're using to conduct your day-to-day business. Example of liabilities would be accounts payable and notes payable. Notice most liability accounts have the word payable in them. The difference between the two is that accounts payable are for those items that we owe that are not having interest associated with them. For example, if I get an electric bill in the mail, I owe that to my community that provides utilities for me, but oftentimes the community might give me 30 days to pay. So I recorded in accounts payable indicating that yes, I legally owe a certain amount, but no, there will be no interest costs associated with this. On the other hand, a notes payable means we've signed a legal document known as a promissory note that says at the due date we not only owe the principal amount on the debt, we also owe interest on top of that. So the accountant keeps the liabilities associated with no interest separate from the accounts for liabilities that do have interest levied on them. Finally, equity, we're going to look at two basic types of accounts that you're going to find in most balance sheets for equity of corporations. That is a contributed capital type of account, like common stock or capital stock, and an earned capital type of an account, retained earnings. Recall that retained earnings is kind of like what we owe the stockholders for undistributed profits through all the years. It's a running total type of account. Very important account. Most stockholders want a little more detail associated with retained earnings. So if something affects retained earnings over here in this L column, we're going to indicate is in effect retained earnings because we sold something, either a product or service, for which we will be receiving cash from our customers. Did it affect retained earnings because some of our resources or assets were consumed in the course of operating a business? Those are expenses. Or is it a distribution of profits to the stockholders, which in business terms is called a dividend? So let's go ahead and try this. We'll go through some transaction analysis entries that I've put over here, over on the right side of the screen, and we'll go through each one and kind of see how it affects the accounting equation. Since this is a brand new business, the balances that we have in all the accounts are zero down here. I've set my Excel spreadsheet to keep running totals of all the balances in these accounts. So we can check at any particular point in time whether or not assets do indeed equal liabilities plus equity. The first transaction, transaction A here, says let's assume the company sells $3,000 of stock for cash. How is the accounting equation affected? Well, cash goes up by $3,000. And who has a claim to that cash? That would be the stockholders. So the stockholders claim to cash because they contributed that capital, gave money to the company to help it get started, would be recorded in a common stock account. Notice down here at the bottom that the assets, that is the $3,000 over here on the left-hand side of the equation, equals the $3,000 balance over on the right-hand side of the equation. The resources the company owns is equal to the claims against the resources that the company owns. The second transaction, let's assume we purchased $2,500 equipment for cash. Equipment is what we get, so that goes up by the historical cost of the equipment we're purchasing. But we paid cash for it, so cash is going to go down by the dollar amount that we spend for purchasing that. Again, notice the accounting equation equals. We have $500 in cash and $2,500 in equipment for a total of $3,000 on the left side. We still have $3,000 on the right side. The third transaction, borrowed $1,500 from the bank. That's going to give us additional cash, so cash goes up by $1,500. But now the bankers have a claim against my company for that $1,500 back. Since I signed a promissory note at the bank to take out that loan, I'm going to put the amount owed to the bank in an account called Notes Payable. So the left-hand side of the accounting equation goes up by 15 for the cash I received, but the obligation I have to outsiders also goes up by $1,500. Now my business owes $3,000 to the stockholders for the amounts they originally contributed to the company. They also owe $1,500 to the bank. Transaction D, purchased $2,000 of inventory with half paid and the other charged. What did I get? I got inventory. So inventory goes up by the historical cost of the items I purchased. That is $2,000. I paid half, which means cash is going to go down for half of $2,000, which is $1,000. And I owe the amount, the other $1,000 to this vendor who I've purchased the inventory from. Vendors generally are not going to charge us interest, so the amount that I owe them is going to go over here on the accounts payable column. And notice that my balance sheet still balances. The running total says my assets are $1,000 in cash, $2,000 inventory, $2,500 in equipment, which would be $5,500. Over on the right-hand side, I owe $1,000 to the vendor, $1,500 to the bank, and $3,000 to the stockholders, which adds up to $5,500. Notice again, if I charge something I'm not going to pay for, I legally owe it. I have to record it in the accounts payable account that so if I prepare a balance sheet on this date, it would show what I owe the vendors. Transaction number 5 deals with equipment costing $700 that was sold for $200 cash, and the rest was still owed. The equipment is sold, so I take it out at its original cost, and that is the $700 cost of the equipment that was sold, so I need to remove that from the equipment account. I received cash of $200. That makes cash go up, so I put that over here in the cash account. And the other $500 is still owed to me by someone. If we're going to give them a month to pay or so before charging any type of interest or requiring them to sign a promissory note, the $500 they owe me would go in the accounts receivable account. So notice one asset goes down by $700, but two assets go up by a combined total of $700. So I exchange my piece of equipment for cash and a promise to pay the rest very soon. Transaction number 6, collected $400 of the amount owed for this $500 owed from the person buying the equipment from me. The $400 check that they sent to me is going to make my cash go up, so I record that in the cash column as a positive number. But they now no longer owe me $500. It's the balance in accounts receivable. They have paid off $400 of my claim against them. So I'm basically exchanging my $400 of my claim against the person who bought the equipment against the $400 cash that they have paid off. So if you notice down here, the running total in the accounts receivable account shows that they still owe me $100. Does the balance sheet still balance? I have $1,600 in cash, $100 in receivables, inventory of $2,000, equipment of $18, $39, $49, $5,500 over here on the left hand side if you add these four numbers up, and I still have $5,500 over here on the right hand side. So yes, the accounting equation still balances. Transaction number 7, let's assume we sold $1,200 worth of inventory for $2,000 in cash. First, let's look at the retail amount of this transaction. I do receive $2,000 in cash, so that makes cash go up. I received that $2,000 because I provided a good or a service, in this case a piece of merchandise to the company. So who gets the claim, or who gets the $2,000 benefit? That would be the stockholders. It doesn't really have to do with any contributions that they made, so I put the $2,000 over here in retained earnings. Whenever I put something in retained earnings, I have to make a little note over here in column L, is why did you affect retained earnings? Is it because you sold a product or service? And yes, that's the reason. So we would call this revenue. We didn't consume any assets when we're recording the retail value of this transaction. So we call that a revenue. On the other hand, you're right, we did consume the inventory. The amount of inventory sold was acquired for $1,200. So if I put it in at cost, I have to take it out of cost. I put a negative $1,200 in my inventory account to show the legal title has transferred. That inventory that used to be belong to me now belongs to the customer. The question is, what happens over on the right-hand side of the balance sheet to absorb this $1,200 cost that was used to help the business operate? We had to have inventory before we could sell it and generate a profit. Who takes the hit on this? And that would be the stockholders. Just in the same way that stockholders get the benefit of selling products or services for more than what they cost, the stockholders take the hit on what those costs or consumed resources are. So I put a minus $1,200 in this account, and whenever we put something in the retained earnings account, we have to indicate, why are you affecting retained earnings? Is this amounts that you're going to bring into the business from your customers for selling products or services? No, those are revenues. Is this an asset or resource that was consumed in the course of operating a business? Yep, that's it. So we would call that an expense. Expenses are, again, resources used up, in this case inventory, that was consumed in the course of operating the business to help us bring in the $2,000 revenue. Transaction number 8, let's assume we paid $500 of the amount owed in transaction D. I write out a $500 check. That makes cash go down. The amount owed in transaction D was put in the accounts payable account, so there's no interest associated with it. But once I pay that person $500, their claim against me is no longer the $1,000 that I owed them, but their current claim against me is now just the other $500. Transaction number 9, if we pay $300 of wages to an employee, cash is going to go down by $300. Who's going to take the hit on that? Well, that's a cost of doing business, so stockholders are going to take the hit on that. So we put that over here in the retained earnings column, which is the running total of how much we owe the stockholders. I owe stockholders $300 less because we've had to pay people to work for our business in order to operate the business. Since we're consuming an asset, in this case cash, in order to bring in the revenues to run my business, we would record this as an expense. Finally, transaction number 10, declaring and paid dividends of $100. We write out a check for $100 that we send off to the stockholders. That makes our cash go down, but it also makes our claim go down of what we owe the stockholders. In this case, the stockholder amount that we owed them was the balance down here, retained earnings of $500. If we give them a check for $100, we now owe them $100 less, or $400. Distributing profits to the stockholders in business are called dividends. Finally, let's look and make sure that our balance sheet does indeed balance. At the end of this little exercise, the cash is $2,700, the accounts receivable is $100, that's up $2,800. Inventory adds another $800, that gets us up to $3,600. Equipment is $1,800, so that would be $5,400. Over here as the total of the asset side, if you add these four numbers together. Over on the right hand side, I got $500 that I owe to the person who I acquired inventory from. I have $1,500 owed to the bank. I have $300 common stock and $400, which adds up to $5,400. Yes, my balance sheet balances. This is the end of my Chapter 3A podcast.